Hello, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you. Today, we're going to be talking about indicators. What are we listed here the top 5 indicators. Um, and I think really when it comes to five, that number may be actually a little high as far as indicators that I think you would actually use and feel like, man, I've got to really know this in order to further my trading. We'll focus in on, I think, 5 things that matter, but some of those I may not consider to be an indicator. And then one of them I actually do consider at certain times to be a fairly good, strong indicator, but it's not something we'll talk about here because it's a bit more advanced than what we would talk about in a setting like this. So probably cover really 3 specifically, and then kind of talk about the other 2, which I don't know if I consider one of them to be an actual indicator. It's just price. Let's go ahead and share our screen here, and I'll go ahead and bring these up to you guys. So you can see a little bit about what I would consider to be our main indicator. So the first one I would say is obviously price, but it's not just, I'm not going to say simply just price. It's like candlesticks, price. So that combo there, your price with your candlesticks, I actually do think that's a really strong indicator. I would say let's just try to do these in order. That's number 1. Obviously, if I can get a sense of what the price is doing with the candlesticks, that's the biggest indicator I would want to have. I would want to have a good sense of what's happening there with a price and candlesticks, trying to give me a sense of what patterns are forming and how I can use those 2 things in conjunction to really make some important trading decisions. Now, number 2, and I would almost list this as 1A, is exponential moving averages. Exponential moving averages are a gauge of time, right? So you can have these different time periods. They're really period moving averages. We do have ours set to exponential. You can do simple, but we're going to use exponential. You're going to find that that's a lot better in the sense that it's tends to be more accurate in predicting reversals, and that's really what we're trying to see here. So exponential moving averages, now you can have these set at different time periods, pretty standard for us, 10, 20, 50. If you're looking at we're looking here at a year and a daily, so each candlestick represents 1 day. If you go over here to 1 day 1, now each of those candlesticks represents a unit of time based on minutes. So 5 minute, 10 minute, 20, 50, etc. But EMAs, they act as potential additional support underneath the stock, help kind of prop it back up or give it a reason to go back up again. But when EMAs are on top, then they act as resistance. So you can think of them as weights trying to push the stock or the market back down again. So I would consider EMAs to be really primary. So you've got your stock and the candlesticks, but right underneath that, it'd have to be like 1A for sure. Would be EMAs, and so you're going to see this chart a lot, where you're going to have your stock, your candlesticks, obviously your price, and EMAs. It's going to be a really important part. And then again, you can just kind of make this real simple. Stock is on top, it comes down. You're just kind of saying what kind of a discount is needed at this time. It hits an EMA, could be the 10, 20, 50, whatever, and it'll use that as support to move back up again. When the EMAs are on top, now your stock has been showing weakness. You can think of those EMAs like weights. They're pushing the stock down, and the stock is going to have to be strong enough to push the weights off. Otherwise, it'll, just like you're on a weight bench, it'll come down and hit you in the chest. So that's what's happening here with this stock. Obviously, TSM, you can see it's under the EMAs. I'll zoom back in here a little bit. So it comes up, it hits the EMAs on top, and then it uses them as resistance and drops back down off of them. And that's what we're seeing today. Okay. So we have price, candlesticks. That's one. Then we have 1A here, which is technically 2, which is EMAs. And you'll hear some people talk about volume. Now, I think volume can be misleading. So I'm going to tell you a little bit about volume, a little bit about the idea here of how we can use volume and why sometimes it can be misleading. So obviously, when you have big volume, you're going to see a significant move. So obviously, as an indicator, volume tells you something, but you're likely already seeing that. So how do we use volume as an indicator? Well, we're really looking to see, is volume higher or lower than the day before? And then what is that movement in comparison to the day before? Or when you look down here, we use a 30 period average. And so what is the average volume over 30 days? And so we can see based on this line down here, is it above average, below average, etc. All right. So generally speaking, when the stock is going up, when it pivots, you're going to see lower volume because people are transitioning from selling into buying. As it starts to pick up, the volume will increase. And then as it starts to get nearer to resistance, the volume would decrease. Same thing. When it starts to go down, you'll see volume. It'll start to pick up as it's dropping. And then you start to get closer to support. It'll slow down. And then we start that all over. Now, the reason that I say volume can be deceiving is that there's a thought that if the stock is going up on low volume, then at any point it could drop on you because, it's not going up on high volume like it should be. What I would say to you guys is stocks go up on low volume. Okay. Sometimes, not always, but sometimes. And it's okay. It doesn't mean that it's going to drop. It doesn't mean that it's bearish. It just means that it's going up on low volume. And that's fine. So what I would say to you when it comes to volume is volume can be a useful indicator. Just make sure you don't put too much emphasis or emphasize things in the wrong way and end up missing opportunities. You're like, oh, it's going up on low volume. Well, I can't really trust that. Trust the charts. Trust what you're seeing. Trust what you're seeing with the price. Trust what you're seeing with the EMAs, your lines if you have them, and don't give volume a place where it doesn't belong. So volume can be a good indicator. It can be helpful. But you don't want to overemphasize volume. I think that can actually do more harm than good at certain times. Another indicator that you'll hear us talk about is MACD and stochastics. I'm going to combine these. So technically they're separate. We'll go ahead and combine these. And some of you guys might be familiar with this concept of the arrows and how that works. And this is where you would get a sense of that. You just go up here to your charts by tradeway, flip over to MACD and stochastics. And essentially, you've got this 20 line and the 80 line here for stochastics. And we're looking for crossovers. So when does the green or red or whatever, it doesn't matter what color it is, when does it cross over the other one moving up? And generally speaking, when this crosses, it tells you that's a good buy point. When it crosses at or near the top side, it's a late indicator, but it says that you already should have sold because this stock is falling. So we'll take a look at this. We're right here. So just slightly after, probably early March. We'll see if we can figure out here in just a second. It indicates that we should buy. And then over here, and towards the end of March, it indicates that we should sell. So let's just go back up to the chart, see if it was right. So right around here, it said we should buy. And then right over here, it said we should sell. So one of the things I always tell you about stochastics, if you're going to rely solely on stochastics, stochastics tends to be great for buys and late for sales. Okay, so obviously if you bought right there, it's a pretty good time to buy. But selling over here means you didn't make much money at all. Okay, selling up there, you'd have been okay. Just basing your moves off of stochastics isn't a great idea. It's not going to yield the kind of returns that you would think. Let's look over here at a cross right here. So that's, just maybe late April, early May. And it says we should sell right around there. So let's go look and see if it got that one right. Late April, early May, we buy right here. All right. So again, crushed that one, right? I mean, we crushed that buy point. I wish you could see the whole thing here, but it just doesn't allow us to do that. So late April, early May, you can see that it was crossing right there. See that? Okay. Nice, right? So, I mean, that was a great buy point. And then it says we're supposed to sell over here. So we'll go see what that would have looked like. And again, we're selling a little late, but not too bad. A little late, but not too bad. And would have been like right about here. So if we were buying there, selling there, pretty good. Pretty good, you know. I mean, and that's just based on stochastics. MACD, a lot of people combine those, stochastics and MACD. They kind of work similarly. You can see that MACD is a little bit more complex here in what it's showing you with all these extra lines and things like that. But again, you're still looking for movement on the low side. It tends to be, hey, it's about time to buy. This is essentially oversold. And then when you get up here to the top, it's overbought. And then generally when they cross, you're headed down. If you see stochastics and MACD offering a similar signal at a similar time, let's go back here to this June 5th area, then that's generally going to indicate that this thing is already headed down, but it's definitely dropping. So again, we're just kind of looking at this area right here. And you can kind of see there that it was definitely falling during that stretch. So again, a little late, but definitely had been falling off its highs when we got that indicator there. Okay. All right. And the last one I would say is a really strong indicator, really best to be used when you're trying to figure out where price points might be, would be the Fibonacci retracements. We're not really going to discuss that one here. It's a lot more advanced. It's kind of messed up on Charts by Tradeway anyway. So we're not going to really go into that one much. You'd have to have a charting software where it was working accurately. But it's based on numbers, and it tells you, like, after a stock has dropped and it starts to recover, where are some places where it might stall out, or the opposite way. It's been going down, where are some places where it might start to stall out going up. So you can use it, after a move up to see how far it might drop, or after a drop down to see how far it might move up. Again, I would, stick it below some of these other indicators very, very clearly, putting it in that spot down there. But it is something that can help you if you have the software set up correctly to make those percentages work. It is based on a percentage move. So those, I think, are the indicators that if you found yourself using those, you would be in a good spot there to take advantage of a lot of the information that you have. And I don't think you really need a whole lot of other indicators. Certainly you can use those, and there are some people that do. There are some systems that do. But I try to tell as many people as I can, you really want to try to keep this simple. And the more complex you make it, the more likely you are to hesitate, the more likely you are to wait, the more likely you are to miss. And so I think it's good to be informed. It's great to be educated, but don't let your knowledge really interrupt you and keep you from getting into and out of trades, because you end up over analyzing what's happening. So indicators are great. They can be very, very helpful at certain times. They can simplify the process, but if you find yourself complicating the process because you're trying to use too many indicators, don't do that. Keep it simple. All right. Well, thank you guys for joining us again for another edition of Tip Tuesday. We will see you next time.